just a bit of a broad spectrum view on what's been happening across the major parts of the resources sector that we cover as a team. And obviously a lot happening in the last week. So just really just an updated view on some of our views on some of the major commodities, especially, but then how to play them. But base metals have been surprisingly weak, really coming back quite quickly as a group and really synchronized with the risk off trade we're seeing across other markets, including equities. It does seem more sentiment driven than anything. We have seen a bit of a bump in copper stockpiles, which are roughly in balanced supply. But looking across aluminium, nickel, zinc, lead, all of them are still in steady decline across their global stockpiles. So that's consistent with our expectation that those markets are still in deficit supply and well supported by fundamentals. Certainly, what we're less sure about is what's going to happen with global manufacturing in the second half. There's room for China to have an uncertain, march out of its lockdowns as they're now easing. We're really expecting more rounds of stimulus to come through, but that'll principally, help to inflate infrastructure and construction. But we're less certain on how manufacturing will perform. Certainly, ex-China, the rest of the world, we see manufacturing still easing, and that's certainly something that the majority of base metals, to generalize, are far more exposed to, along with retail demand. Things like nickel, and aluminium, very much end market sensitive products that discretionary retail are key drivers forward in terms of demand. So ultimately, very healthy fundamentals. Prices have come back. Really, in the short term, could push some of the base metal producers down into value territory. And that's something we're starting to see now across names that the guys like Sandfire, Panoramic. So watching those very closely. Certainly South 32 is in that same camp. In iron ore, I'm actually gaining conviction and bullishness. This is supposed to be the weak point in 2022. This is really peak China COVID impact. As we now see lockdowns easing, and certainly Beijing are flagging that they're going to be very aggressive stimulating coming out the other side. And as I touched on, that's going to really help to inflate construction and infrastructure. So even though this is supposed to be the low point, we're still trading near $135 a ton. So certainly boosts my expectations for the second half. China's steel output, even at this low point, is still at an annualized 1.1 billion tons per year. So that's certainly above, about 6% above what I and some other pundits were expecting. So very healthy baseline of consumption. Then on the supply side, I keep flagging the risks around Rio on being able to keep pace with their iron ore guidance. In my forecast, that at the low end of that range for 2022, so 320 to 335 million ton guidance, I think they're struggling to meet that 320. And really there's a key mine there that is now under some pressure that has to come online immediately, I'd say this month. Otherwise there's going to be a downgrade there. Then you look at the big Brazilian Vale. They're also had a really ugly Q1. Scuttlebutt through the media, at least. We don't have any good contacts at Vale, but media are saying that they're under pressure again in Q2. So that could see a downgrade there. So BHP and Fortescue are doing really well in terms of volumes. But overall, I think the uncertainty around Rio and Vale could really help to put a floor under the iron ore price in the second half at this high level, and then stimulus push it up from there. So we sit above consensus this calendar year by about $20 a ton, which is significant, and really captures that second half strength. And I think that's where consensus will move. So very happy with the biggest of miners. Then energy, just quickly, everyone knows we've got a global energy shortage at the moment. I really think it's likely to persist, even or despite the risk of a global recession. A lot of it is structural shortage and deficit of supply. I've been talking at Morgan's for years about the underinvestment capex wise going back into the oil industry and how fragile shale was. Now that that's been exposed and playing out, there really isn't major supply coming through the other side. So things like an Iran deal would be great, but that only adds 1 to 2 million barrels per day of supply. Theoretically, my view is that a lot of that supply is actually already making its way into the market through back channels. So not expecting any great alleviation of the current deficit supply there either. Certainly the Russia conflict, Fed hiking rates versus global inflation. All of that is certainly seeing a lot of volatility. But in my view, you just have to have some energy stocks in your portfolio just to really provide that energy inflation protection, as well as the above market yields that these stocks are going to have. So, Woodside's done particularly well. Santos has done okay. Santos is still my favorite, just really preferring the free cash flow there. But as I've said before, it's hard to split them, and I wouldn't mind which way clients are, as long as they're in one of them. In terms of the rest of the space, BHP, I keep pushing that one. Steadily, or consistently has been my favorite for about 5 years now. In the past, it was just for its superior commodity mix, but now it's because it's also the best miner of our coverage universe. Certainly outperforming Rio, which has fallen on hard times operationally. Big yield around 9%, even at this share price. Free cash flow yield above 15%, which really is the kind of fundamentals you'd expect out of a small, nimble miner. So really not priced for its free cash flow. And I think that really comes from it being under-owned. It's got a very big share of market of the market weight and of the indexes, I should say. And that's very hard for institutions to hold at market weight. It's certainly a really big position, above 10% for most funds, depending on what their index is. So, and then you've also got a number of institutions and retail who have pulled money out of things like BHP to invest in pure plays like Alumina or Independence Group or whatever it may be. But to me, that's left the big miner, cheaper than it should be, even though the share price looks okay. It's just not matching the free cash flow strength that I see coming through. So I think it'll be over 20 billion US of free cash flow this year. Certainly not priced like it's going to be, and always the potential for a special dividend, as well as that big yield I'm flagging. So South 32, with base metals so volatile, I'd be selective. Certainly a very strong hold through any volatility. Very, very happy with the fundamentals. By the end of calendar 24, they're going to make about 50% of their market cap back in free cash flow. So certainly not bothered at all by the volatility. But if anything, if it falls below 425, I see that as bargain basement and very keen to start buying at that level.